guys, JC Parets here of StockCharts.com, and welcome to the show. So we've been doing this for a few months now. For you guys who have been watching, you're going to hear it again. For those of you who are new here, we try to do three things. We always want to come out with a lesson, right? Something that no matter what, we could learn from. In many cases, it's something maybe I've learned the hard way over the years. In other cases, it's something maybe that we have witnessed recently or whatever the case may be, but always a lesson. Then let's dive into the markets, right? What's going on? What do we like? What do we not like? What do we want to stay away from? I think that's really, really important. And of course, we got to take questions, right? People have questions all the time. Keep bringing them in. Make sure you email us, and we'll talk about it right here. So let's get into it. I want to, first of all, just real quick, I want to show you guys the monthly chart universe. We talked about it last week. A lot of people were asking. We got new monthly candles. So honestly, guys, you know, this is my list. To me, these are the most important assets in the world. If you're interested in this, just email us, info@allstarcharts.com. Make sure to use the password trading tools, so that we know what slide deck to send you, because I give presentations around the world. So, again, this is the monthly chart universe, so you could download it. So I know a lot of people were asking, from last week. So, what is the lesson? The lesson today is to know what you own, to know what is inside of the indexes that you're analyzing, to know what's inside the ETFs that you are trading or that you're investing in, right? I think people really forget what the components represent when we look at something, and I want to just kind of poke in here because this is kind of what inspired it. So this is the New York Stock Exchange Composite Index breaking out to new all-time highs. It looks different than the NASDAQ, for example, because this is essentially the opposite of the NASDAQ. The NASDAQ has no financials in it by definition. It literally says it in the definition of the NASDAQ that it's X financials. There's no energy, no materials, almost no industrials, right? So people that say the NASDAQ 100 is the stock market are fools. It's not the stock market. It's like 44% tech or something like that, or 40% tech. It's a joke. It's a lot of growth. It's a lot of tech. There's no financials. There's no energy. Now, on the other hand, the New York Stock Exchange Composite, remember, this is the New York Stock Exchange, a ton of ADRs. So you've got over half of the largest 100 components in the New York Stock Exchange Composite are international companies, right? These are foreign companies, which is why the New York Stock Exchange Composite has done so poorly for so long, because of that international exposure. Now, let's think about what these countries have that the United States does not, and vice versa. A lot more value, a lot more industrials, financials, energy, materials, natural resources, cyclicals. That's more global and a lot less tech, right? So when you look at the New York Stock Exchange Composite doing what it's doing, I think it's part of that rotation. So know what's inside. Understand that Facebook and Google and Amazon are not tech stocks. They are not in the tech index. When you look at the tech index, those stocks represent a 0% weighting. Now you could tell me, JC, Google is a tech stock, you moron. Of course it's a tech. And Facebook runs on tech and internet and Amazon and AWS and all. Take it up with the index providers. I don't care. I'm just telling you what it is, right? Like, I don't make the decision here. Now, we create our own custom indexes where we include those and see what tech would look like if those companies like Netflix also and Tesla were also in the tech index, and we look at that and let's just, they look similar. But they're in the communications index, right? 40% of the communications index is Google and Facebook. 20-something% of the discretionary index is Amazon, right? So keep an eye on that. And then also, like, the New York Stock Exchange has their indexes where they include some of those in tech. So be careful with that. But when you're talking about the GICs, when you're talking about the S&P spiders, understand what's in it, what's driving these things. Look at the weightings in XLE for energy, a lot of integrateds, Exxon, Chevron, Conoco, right? Big components there. So I guess the lesson of the day is, another good one, financials. Look at financials. 15% of financials is Berkshire Hathaway with a bunch of railroads and stuff like that. So understand the components, because obviously they own a ton of Wells Fargo. I guess they were dumping it recently. I'm not sure. But regardless, a lot of reinsurance and stuff like that. So they're the largest, Berkshire Hathaway is the largest component of the financial sector index. So anyway, the lesson of today is know what you own, know what's inside these components, understand what you have exposure to and what you don't, right? There's a reason why Singapore is breaking out to new highs. Half the index is financials, which are also breaking out to new highs. And there's a reason why the NASDAQ 100 is not, because it has no financials, it has no energy, very little industrials, no materials, no real estate, right? So know what you own. That's the lesson of the day. So I think it's really important. And then again, the New York Stock Exchange Composite breaking out to new highs. Highest levels ever. What do we know about new highs? Is that they are not a characteristic of a downtrend. All right. So looking at the quarter end, what are some of the things that stood out? Obviously, value stocks did very, very well, up over 11% on the quarter. Growth stocks basically flat. If this chart doesn't tell the story of what happened last quarter, I don't know what will. This to me, this is the big story, right? We've talked about it here a whole bunch. Now, I want to go over something. Just because value is outperforming growth, right, doesn't mean growth stocks can't do well, right? In fact, 2004, 2007, an environment that interest rates were also going up, in an environment that growth stocks and technology were underperforming, where financials and energy and industrials and emerging markets were outperforming, natural resources outperforming, growth stocks and tech stocks did very well. You can see growth stocks here in blue, tech stocks here in black, and throughout 04 and 2007, they went up. While interest rates were going up, but they were underperforming. That's really my point, is that they were underperforming. So the fact that they can go up, take a look at what's going on in the NASDAQ. So one thing you guys know about me is I like my charts to be nice and clean. So the fact that you got a whole bunch of stuff on here, right, is further evidence of what a mess it is. The fact that even JC's charts are messy as hell, this is how I like my charts. This is how I like my charts. Nice and clean, nice and clean charts, JC. So when you see this, if JC's charts are a mess, it's because the chart itself is a mess. It doesn't need me, right? And that's exactly what's going on here. Messy market, but a lot of people calling for a head and shoulders top of some sort, a topping pattern of some kind. I have been in the camp that it's more of a mess than a top, based on the weight of the evidence globally. And I think there's some bullish implications here, and if the market's going to go up, like I said, in the past, it's been no stranger to going up in an environment that it's underperforming. What is that? What does that say about the strength of the overall market? Another area of a mess that I didn't bring the chart with me is the small caps, still below the February highs. Micro caps, still below the February highs. So look at last week's slide presentation, and you'll see those charts over the last couple of weeks. We've been talking about it. It's a mess. Now, this one comes from my good buddy, Jonathan Krinsky. Shout out Krinsky at Baycrest. Mr. Krinsky is showing here the seasonal pattern for the S&P 500 going back 30 years. And February traditionally is a weak period, the second half of February and into March, particularly over the last 30 years. And then this is where we're at now. So this is a really interesting time for potentially the stock market to start doing well after a messy, 6 to 8 weeks, depending on what sector you had exposure to, right? It's really interesting because, and I think this gets back to what we were talking about before, it really depends on what you have exposure to. I was having a conversation with my buddy Brian yesterday, and he was telling me that all he hears is people getting smoked, people struggling over the last quarter. Meanwhile, the S&P 500, New York Stock Exchange Composite, all making new all-time highs. European banks, new all-time highs. Not all-time highs, I should say. Very far from all-time highs from European banks, but new 52-week highs and new highs in the European indexes. So anyway, my point is, my friend Brian lives in California, and he talks to a lot of American young traders that focus on growth stocks, momentum trading, swing trading, buying breakouts. And that's their, a lot of one-trick ponies, right? That's worked. So they stuck with that. But when you zoom out and look further, that hasn't always worked. There have been times where that doesn't work at all. A lot of times, in fact. But when I talk to my friends in Singapore, when I talk to my friends in Japan, when I talk to my friends in Canada, they're doing great, right? They're doing fantastic. My Canadian friends, whew, natural resources, banks, industrials, they couldn't be happier. Now, those with the home country bias over the last decade have paid the price, right? Virtually no return on Canadian equities because of so much exposure to natural resources, to banks, and a lack of exposure to technology and growth like the United States. And I'm just not hearing the frustrating stories from my friends in Singapore and my friends in Canada. I am hearing it from my growth trader friends in California that are young, trading growth stocks, they can't comprehend buying energy stocks or banks. Like that's like the last thing they have ever wanted to do because they've never had to do that because they haven't been trading that long. And those have been the worst places. So now they have to learn like we did way back in the day, right? So I think that's really interesting is that the geographical location of where you are and how that impacts the types of stocks that you're trading and investing in is basically impacting and deciding what type of conversations I'm having with those people. So I really think that's interesting. So I just wanted to point that out. All right. So anyway, because we can be in an environment where growth stocks are going up, they might not be going up as a group as fast as value, for example, like here, we actually do still focus on growth stocks. There's nothing wrong with it. There's going to be winners. We know that. We want to be a part of it. That's why we have the 2 to 100 club. These are the stocks that we think are going to be the next $100 billion companies. These are growth stocks. So why am I showing this scan? Because there are going to be names coming out of here doing well. In fact, mathematically, the names that are going to be the next $100 billion companies have to come through here, right? That's how we developed the scan. And we mentioned this last week. Qorvo is a $20 billion semiconductor. We like this long if it's above 177 with a target of 270. This was a big winner for us last year, has consolidated nicely. And, you know, the risk versus reward is skewed in our favor because we don't want to be long if it's below 177, right? It's somebody else's problem in that case. We only want to be long it's above 177. Sean likes this on the option side. The November bull call spread. Let's see. The November bull call spread, this was put on the 29th. So long the November 200 calls and short an equivalent number of the November 250 calls for an $11 debit. So again, bull call spread on Qorvo. Long the November 200 calls, short the November 250 calls for an $11 debit. So just an interesting, different way to take advantage of that and get in a little bit of income from the premium that you're getting. So again, if you're interested in these slides, info@allstarcharts.com. Make sure to use the password trading tools. Now, from an intermarket complex, what are we seeing? This copper gold ratio. Don't stop. Is this ever going to resolve in either direction? I mean, we have been watching this thing do nothing for a month. Nothing. I've been waiting for a move in one direction or another for weeks. I'm like, oh, today's going to be the day. Oh, this week's going to be the day. Nothing. So, I mean, just punch it up in your own because we zoomed out in this chart. But if you really want to see this frustrating turn, you know, the longer it takes, the higher the probability that it's not a bull flag, right? And that gold is going to, right, that the copper gold ratio is going to resolve down. So, I mean, gold's going to break out relative to copper, which means lower rates, not higher rates. What does that say about the rest of the market? Does that mean messy for longer? I think it does. If the copper gold ratio breaks down and interest rates start going down and bonds are going up and gold is outperforming base metals, I don't think stocks are doing great in that environment. I really, really don't. So this copper gold ratio, I hate to keep bringing it up. I'm like Mr. Copper gold ratio guy now all of a sudden. This is a really important situation taking place here, and we're going to be watching very, very closely. Because if interest rates are going down, how are financials doing? Right? How are financials doing? So we're going to keep giving financials the benefit of the doubt coming out of this 14-year base. Have to. Financials higher. And if financials are going to go up in the United States, they're going to be going up in Europe Take a look at the European banks here. This is how it looks like to me. A couple of false starts. 1, 2, 3. Like, let's go, baby. So, you know, it's only polite to knock on the door a few times before you go barging in. And I think that's what's been going on here for the last few years. I think it's time to go barging in. Let's talk about a trade. Regional banks are at a very critical level. Like that copper gold ratio, I have to believe if that copper gold ratio resolves down, regional banks are probably going to resolve down also. Let's call it 64, right? So if regional banks are above 64, we got to give it the benefit of the doubt to the long side. That means that we're above the 2018 highs. I like the KRE September 75 calls. This is the implied volatility, relatively low. So let's just go out and buy calls. We can go out 6 months. You're paying $250. So the most you could lose is the premium that you're buying for the calls on the KRE. But for an added layer of risk management, if we're below 64, all bets are off, right? So now you're not losing the entire 250. Maybe you can salvage half of that, right? Or maybe more potentially. So the number one, my favorite part about buying calls is that there's implied risk management already in there, because the most you could lose is the premium you paid. So financials can go to zero tomorrow, and the most we could lose is $2.50. That's a nice situation. But what if we can only lose $1.25 if we're wrong, right? Or $1.50 if we're wrong, or $1 if we're wrong? We could salvage some. It might not seem like a lot, but at the end of the year, that's going to add up, right? So keep that in the back of your mind. So 64, if we're above 64, we give KRE the benefit of the doubt, especially with financials breaking out to new all-time highs, right? But that's the level, 64. And those are the September 75 calls. All right, another interesting development that must be pointed out here is gold miners, with silver making new lows, gold retesting the former lows, gold miners putting in a higher low, right? Gold miners putting in a higher low. So to me, that's interesting. That's an interesting bullish divergence that, you know, quite frankly, I didn't really anticipate having. We put on that gold trade, if you recall, about a month ago, actually. Yeah, exactly a little bit over a month ago, because we got back to that 31 level, right? There was a lot. This level of 31 goes way back, way back, way back, way back. And Sean liked this, the bull call spread. So this is from a month ago. This is from a month ago. It's a bull call spread on March the 5th. Long the September 32 calls, short the September 40 calls for a $2.15 debit. So long September 32 calls, short the September 40 calls for $2.15 debit. September bull call spread, just a way in the options market to take advantage of this particular situation with higher volatility, because on the way down, volatility picked up. So rather than just buying the calls, you can put on a bull call spread and finance some of the risk that we're putting on. Keep in mind, folks, that gold is the worst metal to have owned over the last year. You could literally own any other metal but gold, right, over the last year. So this thing's gotten killed, particularly on a relative basis. I mean, anything that any of these gold bugs have ever told you has been proven wrong. You know, the money printing and the Fed and the this and the inflation and gold and fiat, like all that stuff was wrong. Like very, very wrong, which I think is further evidence of why we want to ignore all those narratives and all those stories. Like, we're adults. Do you really need a bedtime story to sleep at night like a child? Like, is that really necessary? You know, I've come to the conclusion that it is not. And I would rather ignore those stories. I mean, get your dopamine fix somewhere else. Why do you need these stories? It's nonsense. It's poison, really, is what it is. And I think that this chart really tells that. It was a very convincing story, this money printing and this Powell and all that. It's a very convincing inflationary story, and gold and fiat and the end of the dollar. Very convincing story. But that's all it is. It's a story. It's like the Easter bunny, right? It's like the tooth fairy. Same thing. It's no different. So price is the only truth, right? It's the only thing we can actually believe and count on. This shows that, right? Shows that. They don't want gold, man. They don't. It's the Easter Bunny, right? You don't need that story. You don't need that story. Now, with that being said, we're long gold miners, right? We're long gold miners, a logical risk versus reward. It's been working. It's up 10, 11%. Strazo and I were talking. He's like disappointed by this trade. He's like, what if you have a time stop? I'm like, dude, it's up like 10, 11%. What's wrong with that? Kids these days. Strazo's listening to this. He's going to laugh. If I will say this, if we end up getting stopped on this trade, and Strazo agree with me, if we end up getting stopped on this trade and we break below 31, that is all she wrote for gold. This thing's in big, big trouble, right? Now, so far, that's not the case. So far, the gold miners are working, right? We're not long the metal. It's the GDX that's showing that relative strength. Take a look at Newmont, also really interesting for sure. Sticking with this theme over the weekend, we got a breakout in Ethereum. It's being tested as I record this. But man, if this sticks, we're looking at a multi-year base in Ethereum. This is like buying Bitcoin at 20,000. That's the equivalent to me. This is like buying gold at 2,200, 2,100, right? So think of these highs as the gold highs in 2011. We're stuck underneath it in gold. And then if and when we ultimately break out in gold above those 2011 highs, we want to be buying that. Now, in this case, this is not gold. This is Ethereum, but the chart looks exactly the same. It's the same bet. It's the same strategy. We only want to be long if we're above those former highs, right? And that's been working. But now over the weekend, we got another interesting development, and now we did break out to all-time highs. Now it's retesting that breakout, right? Because if this ends up being a failed breakout, then it's going to get ugly, right? So clearly we need to be above these downtrend, these converging downtrend lines in order for this thesis to be valid. But this is the bigger picture. So keep that in mind. So it's really, really interesting from a structural perspective. The trade is to be long above 14.25, which is these former highs, and that's been working. From a short-term tactical perspective, we only want to be long if we're above this downtrend line from the first quarter, from the first quarter highs, right? Something to keep in mind. All right. And then if you're interested in these slides, make sure to email info@allstarcharts.com. Make sure to use the password trading tools. All right. Now let's go to some of these questions. Let's go to some of these questions now. All right, JC, do you use options or stocks in order to put the trades on? Listen, I think that's a great question. I think it depends on, for me, it depends on the situation, right? So I'll give you a great example, and then I'll toss it back to you. So for me, if there's a defined level of risk, right, where I can say, okay, I only want to be long, like in the GDX, for example. I only want to be long if we're above 31. If we're not above 31, all bets are off. Then I would be inclined to put on an equity position. In other cases where it's not as clean, it's a little messy, but I want exposure, I need exposure for whatever reason, then I could be in an option because it's going to give me that exposure with already defined risk in the option as opposed to an undefined risk in the equities. I hope that makes sense. So in a worst case scenario, I can't, people are like, well, JC, options are riskier than stocks. It's like, well, they can be, right? A knife can be riskier than a fork, but you're going to have a hard time cutting a steak with a fork. You need a knife for that. So there are tools and strategies that for different situations, right? And if used properly, like a knife is used properly, if options are used properly, it's actually much less risky than stocks, and stocks are much riskier than options, right? It depends how you use them, right? If you're irresponsible with options, then you could just be Mr. Gambler at a roulette table. You could do that too. That's not why we're here. We're here for two reasons. We want to manage risk, and we want to make money. Notice how managed risk was the first one. Everybody's like, oh yeah, we're here to make money. No. The first thing you want to do is keep the money you have. The second thing you want to do is make money. I think that gets lost. That wasn't even a question. That was just me going on a rant. But that's really what it is. What is our job? I think it was Warren Buffett, right? Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. That was Buffett, right? Somebody check my, do we have a stat check? Stat check. All right. So, okay, now it also comes down to your objectives. What are your objectives? Are you a long-term investor? You know, you're looking to make money over quarters, find bigger trends. Are you a financial advisor that is putting money to work for clients in sector ETFs and whatnot, right? You have no business buying weekly call options. Like, why would you do that, right? That expire in 3 days. That's just not that's not your bag, baby, right? That's not what you're here to do. Now, on the other hand, there are traders that are trying to make money this week. They're finding opportunities. They're finding an arbitrage this week. I know very, very good and successful ones. They have no interest in putting away money into a small cap Vanguard, whatever, right? Like what? What is that? So I think there are tools in the market, and more every day, that help investors of all kinds. And then it's up to us as investors to identify who we are, to then be able to decide which tools to use to help us accomplish our goals. And I think the one thing that, or one of many things, but one thing in particular that gets lost among conversations and debates and Twitter and the whole thing is that we all have different objectives and time horizons. So I'm talking about how this stock is making a new low. It's like, oh, JC, this, yeah, but they have this new drug. And it's like, I don't care. It's making new lows. What do you want from me? Right? But then there's another kind of investor that's like, yeah, baby, come to Papa, new lows. I know more about this stock because I used to work there, or my cousin, and they got this drug. And with any opportunity that it goes lower, I'm going to buy more. And then they'll make, fine. What does it have to do with me? Go for it. Have a ball. Go buy your lows. You do that. Go buy that breakdown. You do that. I'm not, right? But we have different objectives. We have different time horizons. And again, you've heard me say it before. I'll say it again. There's 3 questions you want to ask. Number 1, why are you here? What are your objectives? What are your goals? The hell are you doing here? That needs to be defined. Number 2, how long are you trying to make money in this trade? It's like, JC, what do you think of Apple? And I'm like, well, like in the next 5 minutes or over the next couple of quarters? Like, what do you mean? What do I think about Apple, right? So know your time horizon. Know your time horizon. Are you trying to make money today, this week, this month, this decade? Who are you, right? So know your time horizon. So why are you here, and how long are you trying to be in this trade? And then the most important probably is, how much are you willing to lose? How much money are you willing to lose in the off chance that you don't get this trade right? I go as far as assuming I am going to be wrong. I always assume I'm going to be wrong. I just assume that it's a 0. How much money am I going to lose in that scenario? And am I okay with that? Right? And I need to choose a dollar amount that I'm going to be okay losing. And the dollar amount that I choose, and the dollar amount that Straza chooses, or Sean, or Willie, or Ian, or Grant, or Louie, or Rashmi, anybody on the team, or you, we're all going to have different answers. Because we're all here for different reasons, with different time horizons. So I think that's really important to identify. So again, if you're interested in the slides, info at allstarcharts.com, password trading tools, info at allstarcharts.com, password trading tools. Folks, I'm JC Parets. Thank you for joining me today, and I'll see you next week. Shout out StockCharts TV. David Keller, what up?
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.